Hello, Jim here. One of the greatest ways that I've found to make some extra income on a monthly basis is selling options. And probably my favorite strategy is the option wheel strategy. I've been doing it a number of months now with different size accounts, and I found it to be very, very profitable. Today, I want to talk about that. I want to talk about the strategy, how it can be a really safe way to make some extra income. I'll go into detail about the trades, how I've done the past few months, and kind of share with you my perspective why it's such a good way to actually make some extra income. So stay tuned. I think it's going to be well worth your while. Okay, now I've been running several wheel strategies within my membership for primarily for different size accounts. I have this one, which is my conservative wheel strategy that I'll go over today. Then I have what I call my balanced monthly wheel strategy for bigger accounts around 25 or 30,000. And then for accounts that are much larger, maybe 80 to 100,000, I have what I call my spread wheel trades. Today I'm going to primarily go over my conservative wheel strategy, which is for small accounts around 10,000. Could you do it for with even smaller accounts? You could. You could actually do half the number of contracts that I'm doing here and potentially do it with a $5,000 account. So let's jump right in. So I've been doing this for 3 months. The first two trades I did were back in January. I did one on HIMS and then the other one on Fiverr. I'm going to go into a little more detail about the specific companies. HIMS is an online medical type business. Both of these are online businesses. HIMS, I believe, offers a lot of different medical stuff related to hair loss and maybe even reproductive stuff. And it's both these companies have good profitability, have done fairly well, and they're not overpriced. They're also fairly inexpensive. Fiverr was 28 at the time, or right around 28. It might have been closer to 30. And then I think HIMS was around 25, but at the time when I did these trades, they were both around a 20, 22 delta. So the first one, HIMS, which I closed since then, I made 182.66 on two contracts at 22.50, and it was like 118% return, which is really good considering it's based on the total amount of required capital. Now, if you're dealing with spread, your required capital may be a lot less, but in this case, it's it's calculated using the total amount of required capital, meaning the 2250 times 200 for 200 shares minus the premium you've collected. So a fairly good return. Now the other one is Fiverr. Fiverr I use, it's almost like an Upwork or where you can get help with graphic stuff. You can get someone to help you with icons or logos or voiceovers, pretty much anything you can imagine. I end up using it fairly often. Probably I do one project a month with it, either graphics. I also have gotten people who can help me with certain kinds of coding too. So I used to use Upwork a lot, but I find I use Fiverr a lot more often. So I use it. I like them. I opened this position again back on January 8th. Expiration was 221. The HIMS was 131, so it did have a little bit of a shorter DTE. That's also why it had a higher return. So this one, I believe Fiverr only has monthly expirations, but I brought in 178, didn't take a huge amount of risk. And then like HIMS, it's based on the full capital. So it's this 28 times 200. So the stock price times 200 shares minus whatever premium you bring in, which is 54.21. The two added together is not quite 10,000. So that one I had about a 27% return. But between the two, I made $361, which if you had just a money market and you had a $10,000 account, that might be what you made for the entire year. Now, the beauty of this is infidelity. So I'm also earning interest while I'm setting up these cash secured puts. Fidelity has what's called a true sweep account. So I'm able to earn money market interest rates while I'm using the same cash for writing cash secured puts. So I literally in 1 month made 360 some odd dollars. So HIMS shot through the roof, so I closed it and I have not opened a new one with it. I switched to a different security and I'll talk about that in a minute. But I rolled Fiverr and I was able to roll it out. It did drop. We early February we got into the market started its downward trend, and it dropped a little bit. It's I think right around $25, $26. It's still around 25 or 26. So I was able to roll it out to 321 would be the new expiration. Brought in another 175, so almost the same amount I made the first time. And again, I probably should make the required capital less. It really should be the total amount I brought in. But 54.24 is still a fairly good calculation. And I made the trade on 2/6, so the DTE isn't too big. So it's almost like a 30, what is that, a 30% return. And then instead of using hymns, I decided to use, which I find it interesting that the names sound similar. It's another company, Kins, and I'll jump into those at the very end of this. But I did a new trade on it. This time I did do a spread. I didn't have to, but the $10 put was dirt cheap. I think I paid a few dollars for it for each one. So I did three, 15, 10, but you could potentially have done just a cash secured put at $15, which would have been around 4,500 required capital versus, 1,200 is what I ended up needing. This was a 43 Delta. So even though Kins is a really small company, I mean, they're a small company, but they don't have a whole lot of strikes. I believe the strikes are every $2.50. So I think there's a 12.50, a 15, and a 17.50. So, which kind of makes it nice because if it does get assigned to me, I'll sell the covered call right again at 15. And I found the covered calls also have very good premium. So this one I brought 291 in. And this was almost like a 400% return. My required capital was 1208.86. Again, that's the spread. So the 15 minus the 10, $5 times 300, which is 1500 minus the 291, which gave me probably my highest return I've had in a long time. So I believe Kansas also just like Fiverr. It doesn't have weekly expiration, so I've had to wait. It did expire. I did not find very good premium to roll it, so it just literally expired a couple days. Well, Friday. So I'm going to do a new trade on it here shortly. So Fiverr, I did do a new trade on it on 312. So I had again been able to roll it. It did get a little bit deeper in the money, so I couldn't make as much rolling it, but I did make 121. And again, using the same calculations, this was like a 22.48% return. So again, did fairly well with it. Now I'm looking at Ken's, and I'm looking to do a new trade on it probably on Monday. The numbers here are based on what it looked like the end of day Friday, but a new trade on Ken's with an expiration of 417 and a 40 delta would bring in close to $200, about 198, and it again would be a good return. Now Ken's was up on Friday, so these numbers could be low. It could be closer to a 300% return, but again, 198 with putting, $1,300 at risk, or if it does get assigned to me, 4302. But I would turn around again and sell a covered call right at 15. So still a very good return. Now I'm also looking at Sofi. Sofi's been on my watch list a long time. I've had a lot of members saying, why don't you trade Sofi? I really like Sofi. Why don't you look at it? I won't trade companies until they start making money. So they were on my watch list a long time. They still seem pricey to me, but they're expected to do 50 cents next year, so they're not as pricey. But again, if I'm running the wheel on them, and I don't really care to own them, because again, this is different than a lot of my other strategies. I'm just going to roll them and hopefully make some pretty good income, and hopefully they stay around 12, anywhere from 11 to $13, where I can continue to roll them and bring in a lot of premium. So the estimate for Ken's was again 1510, bring in 198, and then for Sofi it would be, oh yeah, and Ken's was again 3 contracts. Sofi would be 2 contracts at $10 or $12.50 and $10, so $2.50 spread. Again, if I can buy a put, I will. If you don't have that kind of, you need a higher level of trading options. I believe for Schwab, it's like level 2. But if you didn't have that, you could still do it as a cash secured put at 12.50. But I found the $10 long put was relatively cheap. And if I can buy a put relatively cheap, I'm going to. I've been able to purchase some long puts for like $3 or $4. I think Mara, for one of the first trades I did with them, it was like $3. So here it would be like a 38 delta, and then I'd bring in 100, but this is a little bit of a shorter expiration. Now, if I went out the next week, which I believe is, yeah, it'd be 417, that would be closer to 150. So a little bit less premium. But the call premium looks really good. The idea would be to do more than one trade in the month, but I'm only putting at risk $400. Now, if it all gets assigned to me, it would be 2,400. But again, I would keep running the wheel. I would sell the calls on it. And I found the call premium on both these, and I'm going to show that here in a minute. Looks pretty good. So in the second month, I made probably the most I've made, 450 or 466.48. And then in March, if both these trades work out in the next day or two, on Monday or Tuesday, close to 419. So, and then with a total of 1247.14. So again, that alone is like a 13% return on a $10,000 account. It would be really hard to do that even with really good stocks, even during a bull market. Now, if you just had S&P 500, you potentially would do better than that. Or gold. Like if you had gold last year, you blew away everything else, including the S&P 500. So now if I look at this, it's 1247, but then I've also earned interest. So on this $10,000 for 3 months, I would have earned close to $126. The total income would be 1373.51. And then the monthly income would be 457. So every month you could potentially make right around 450 on a monthly basis, which is really good. Now if you did it like I did it, and you do have the ability to do spreads in this account, your return would be even higher, because the only risk you're putting at, or the only capital you're putting at risk, is 7180. And then your monthly return would be over 6%, like 6.38. On a yearly return, that's almost 78, almost 79%. And you would be doubling your money almost every year, which is outrageous. Now, if you didn't have that and you were using, the full, meaning you had to do cash secured puts, you couldn't do it as vertical put credit spreads, or everything got assigned because we had a massive dive in the market, you'd still be earning close to 3.76%, or close to 4% on a monthly basis, which is 45% on a yearly basis. Again, can you make that kind of a return anywhere else? It would be fairly difficult. Now, again, this is based on 3 months and assuming I can make these next 2 trades, but it's pretty realistic. Or even if you only got half that, that's still like a 22, 23% return, which would be very difficult to do on your accounts. So 45% return is like doubling your money using the rule of 72. You just divide 72 by the interest rate. It'd be like doubling your money every 1.6 years. So you can do quite well with it. So just with a few trades each month, most of these are monthly trades. So I make the trades, and then, I don't typically worry about it. If this is all I was doing and I didn't have other strategies, then you're talking, very little amount of time that you would need to manage this. So pretty cool that way. So testing how well the wheel strategy. So my main goal is showing people you can do really well with the wheel strategy in small accounts. You do have to pick the right securities, as always. And I'm still sticking to my point of picking good companies that have good fundamentals that aren't overpriced. And again, in a minute, I'll share with you what these companies look like, at least the last 3, the Fiverr, Kins, and Sofi. It can be more difficult to make a high return due to limited resources. because you can only do fewer, you can't do as many trades. You end up doing fewer trades. But again, you can still do pretty well. And there may be an argument to be made that you can do better in the smaller accounts because one trade can really blow up your account up. Of course, a bad trade can also, take you down and give you a negative return pretty easily. I'm going to allow fins to be assigned and sell covered calls. That's true of any of these. I'm willing to let them be assigned. And the funny thing is I've wanted them to get assigned and they haven't, which has been surprising. The option premium is limited for a roll. So once it does get in the money, the deeper it gets in the money, it's harder to make as much. You might have to wait for the assignment, then sell the covered call. And especially during this time period, as we've been going through a correction and, not really a bear market, but definitely a downward trending market. Rolled Fiverr, but hope for assignments again so that I can sell covered calls. And it's funny. It just doesn't seem to happen. Now, if it gets to expiration and it's still in the money, I am going to let it get assigned to me. And then stocks are holding up fairly well. So all three of these companies have held up fairly well. And other good, less expensive stocks. This is where you guys can also help. Let me know what you think. What would be some other good companies for a really small account? So other than Sofi, Kins, and Fiverr and Hims, you could also look at Ford or American Airlines, which is AAL. So next, let's jump in and we'll just take a quick look at these three companies: Sofi, Kins, and Fiverr. So stay tuned. Let's jump into the next section. Okay, now the first company I want to look into is Fiverr. I just want to give a quick update about it. So you can see here, they did miss earnings and I think they dropped, but they've been trading right around 25, 26. Their PE is relatively low at 10. Earnings per share 257. If we look at their valuation, they're not considered overpriced. Look at their capital structure. We can see market cap just shy of a billion, 992. Their debt, they do have 463. So right at that 50% debt to equity, they do have a good amount of cash. Profitability, this keeps moving over. Good, but not great. They do have some negative profitability. They also just recently started making money. So that's probably part of it. Give them another year and they probably will show even better profitability. I do believe they have pretty high retained earnings. So growth, good but not great, even though it's D plus. I do like to see the 8 to 9% revenue growth and fairly good earnings growth. Let's see. I also like to come over here and look at earnings. I like to look at these earning estimates, which 257, then 258. So not much of a gain between 25 and 26, but then a good jump to in 27, almost to 376. So good growth, not great. Financials, we can see here I guess they've been making, well, we can look down here to see if they've been making money, but okay, that was operating income. So they've only recently started making money. And then here you can see they had losses, earnings from continuing operations. So they started making money in 23, probably towards the end of the year. And then 24, it looks like they made about 18 million. Other thing I like to look at is at balance sheets, see if they're still issuing a ton of shares. And here we can see total shares 35, 30 stayed, well, that's the same year. Actually reduced it. They bought some back, but then they had increased. So they were at 31. So it looks like they've recently started decreasing. In 23, they went from 38.7 to 35.9. So it looks like they might be buying back some shares, which is also good. I don't think they pay a dividend. Let's look. I don't believe they pay a dividend. So a fairly good company. Now let's look at their options. And let me move this out of the way. I'll move it up top. And we can see here, so $6.62, pretty good premium for an inexpensive stock. And again, same thing here, 163 to 130. These are the calls. So you can make even better income or about the same on both the puts and calls. Now, this is expiration on April 17th, so they primarily are monthly. But again, that's not necessarily a bad thing. You make one trade, it works out pretty well. And then if if it gets called away from you or put to you, you can then run another trade and sell a covered call. So maybe make $1 here, it gets assigned to you at 25, then you can sell a covered call at 26 for the same expiration. At least that's what my thought process it has been. It's been surprising how few have actually been assigned to me on all these wheel strategies. So that's Fiverr. The next one we'll look at is, I don't think it's Fins. I think it's Kins. Yeah, it's Kins. You can see I get confused sometimes here, but Kins. And the risky part of Kins is they're a relatively small company. I believe they only have, let's look at financials, I think 128 million. So they're very small, which is risky. Just the nature of being small makes them a little bit risky. Now, profitability, they've got fairly good profitability, A minus. Margins could be better, both for earnings as well as gross profit, but they have really good return on common equity, return on total capital, so that's good. So good, fairly good profitability, growth, not bad, almost 8%, and then revenue growth forward looking is almost 20%, so not bad. Valuation, they're not overpriced, which is nice to see. 219 is their market cap, so again, they're relatively small, tiny company. Total debt 11 million. They have 28 million in cash. Let's go back to profitability out of curiosity. Cash from operations could be better. Um, let's also look at earnings estimates, and I don't think they changed that much. $1.80, then $2. But again, they have a fairly low PE, 8.53, and then it drops to 7.68. So, and they're fairly inexpensive if we, that's what I mean. Even though they're very small, in some ways they're less risky than some others. You may be curious, what do they do? Let's take a look down here. So it provides property and casualty insurance and products to individuals in the United States. It offers personal line of insurance products. So it's primarily an insurance company, but property and casualty, which I don't know if they've been impacted by the fires, but they're in California, but the numbers look pretty good. I don't know if they've been impacted by the hurricanes or anything like that, but fairly good to trade. Now let's look at financials. I'm curious if they're buying back shares or what they're doing, since they've been around and been a pretty small company for a long time, 13, 11. So they've been issuing more shares. They did in 22 and then again in 23. So they have been issuing shares. That's a little bit risky. Um, let's look at options and you'll see what I mean. So the next time is April 17th, and you can see here 15, 12.50 or 10, talking $85 for a put at 15, or if you sell a 17.50 call, well, that's really low, but if you sold a 15 call, $1.72. So they actually have better premium for the call. So, again, a fairly good company. The risk factor is it's a small company and the cash flow could look better. So, I'm still sticking to my guidelines. The guidelines look good. It's not overpriced. Did we look at debt? Yeah, I think we did. We looked at debt and some of the other stuff. Yeah, relatively low debt, which are the key things I like to look at. So again, a fairly good company, fairly inexpensive. So we did Fiverr and we did Kins. Let's look at Sofi. Now, a lot of my members, like I said before, and if you're curious about my membership, take a look at my description. I have 3 different levels. It's very active. I'm adding more and more. I have 3 different wheel strategies, and I'm going to continue to kind of expand on those and provide more and more to my membership. So it may be worth your while to take a look. So here is Sofi. Again, I've had them on my watch list a long time and only recently started trading them. So let's see what profitability is. It could be better. Profitability doesn't look the best. Growth is good. They have A growth, so almost 27, 28%. Revenue growth, 22. Valuation, let's 14 billion. Total debt, 3. Cash 2.8. I believe their cash flow may be good, even though their profitability, cash from operations, isn't the best. No dividends. Earnings, let's see what their earnings estimates look like. So 26, 50, 74, then it drops a little bit, then goes up to 91, then $1. So definitely could be a very good long-term company. I wish their profitability looked a little bit better. Let's look at their financials. Let's go to the balance sheet. I'm curious if they're still issuing. My guess is they probably are issuing a lot of shares. Let's go down a little farther. Total shares, 1096. Yeah, they're still issuing a good number, 934 to 976. So that isn't the best, the fact that they're issuing a lot of shares. So, but again, since I'm looking at doing this as the wheel and I don't really care to own them long term, I just want to run the wheel and make some pretty good premiums off of them. I think in this case, it's okay. I'm not sure I'm going to trade them to own them outright unless things significantly change with them. Their profitability is a concern and their cash flow is a concern, plus the fact that they're issuing so many shares. But here we can see this is, yeah, March 28th. Let's look at April 17th so we can just compare it. So here, if you do a 12 put, you're bringing in around 42, anywhere from, this was 86, 42 to 86. And then the calls are really good too. So it's between 12 and 13. And you can see it drops significantly. So you could potentially, you did a 13 and a 15, $18, or yeah, that's $16 to buy the long call, or $6. Same thing with the put. So you could do a 12 and then $8. An $8 long put is only $2. So I think they were up. So that's part of the reason these numbers would look a little bit better on the put side if it was a down day. So those are the three stocks I'm looking at. Again, I'm curious to what you guys think. What other companies would you suggest that could be added to this? And then are you doing something similar? Now, any of these trades that I shared over here with the spreadsheet, these can be done in bigger accounts. You could do more contracts potentially. So it's not just limited to small accounts. Now, I do like these, the fact that they're inexpensive. The chance that they drop majorly is limited because they're fairly inexpensive stocks, and they're currently, with the exception of maybe Sofi, not overpriced. Kins and Fiverr are definitely not. So, let me know what you guys think. Do you have a better candidate than these three, or would you do something different? I'd love to hear. So, and as always, thanks for taking the time to watch, and I look forward to seeing you next time.